good evening and welcome to the India Development Debate. I'm Tamanna Inamdar. The number everyone has been watching out for today is the CPI number. Now here is why. Because inflation at about 6% is something that the RBI has flagged off as a problem. And for the second month in a row, we have had an inflation of above 6%. It's slightly better than the month of May at 6.26%, but nevertheless above the 6% mark. The worry with inflation is that it will place spoil sport to India's attempts at recovery. We also have seen the May IIP figure, which is better than expected, but on a low base effect. So what is the overall picture that is being formed? That's what we're going to discuss on the lead story on the India Development Debate this evening. Well, joining me in the show and the discussion is Aditi Nayar, Principal Economist at ICRA, Aditi Nayar jointly heads South Asia Economics Research at Standard Chartered Bank, and Dr. Devendra Pant, Chief Economist, India Ratings and Research. Welcome to all of you and thank you so much for speaking with us today. Aditi, let me begin by getting your take on the headline numbers and research. Welcome to all of you and thank you so much for speaking with us today. Aditi, let me begin by getting your take on the headline numbers that we've been seeing. Overall, what can be the takeaway is that at least inflation is steady and IIP could be pointing in the direction of recovery. Would you agree with that?
So today's CPI and IIP data did offer a bit of a positive surprise. The IIP eased sequentially and the YOY growth flattened, but not as much as what we were apprehensive about. So the impact of the state-wise restrictions as far as the industrial activity is concerned was not as bad as what the GST e-waivers had suggested. So the IIP number has not fallen as much as what we thought it would. On the other hand, the CPI inflation we expected would come in at 6.1%, which was well below the consensus expectation. The CPI inflation was flattish at 6.3% in June, but at least it's a relief that it hasn't hardened even further above the surprising print that we got last month.
Aditi Nayar, how do you look at the numbers that we're seeing today? Important among them is the fuel inflation, which is about 12% of weightage. At 12%, it is still hotting. But because the overall food inflation has seen some kind of a relief, do you think that that impetus, that push to reduce fuel inflation might now be lacking? What is your view overall on the numbers?
Sure. On CPI, I think this number is a clear relief to the market because the consensus was above 6.5%, especially after the May shocking print. Going forward, our sense is that probably we have seen the peak in CPI. Secondly, what's more encouraging in the CPI print is that the core CPI has come off from 6.4% towards 6.16%. And that effectively shows that some of the sharp spikes which we saw on a month-on-month basis in the month of May, that has either stalled or in certain subcomponents like say recreation or for that matter even in personal goods and services excluding gold, there we have seen a reversal. Thus, that also should provide some comfort. The third part is that if we look at the CPI, month-on-month changes across, the sharpest increase has been in case of food inflation, plus 1%. While, the overall number has been lower, I think from the future trajectory perspective, we'll have to keep a very close eye on food inflation trends, especially given that monsoon rains have been deficient till now. So on an overall basis, our full year CPI projections are at 5.4% for FY22. And the key monitorables are food CPI, especially given the monsoon deficiency. On core, we think we are pretty much on track, especially after the June CPI print, where we expect it to average at around 6% for FY22. On IIP, I think the YOY numbers really don't say much. It's pretty noisy because the base effect is highly favorable. And going forward we are likely to see IIP seeing in strong double digits. What matters more is the sequential decline. And there we did see some decline between April and May, but not as bad as we were expecting. And From the growth perspective, a double-digit IIP print will keep the Q1 FY22 numbers in high teens. And from the full year perspective, I think more than IIP, probably what we'll have to keep a close eye on is the corporate earnings, which have been pretty robust till now.
Devendra Pant also joins us on the show today. Devendra Pant, a number of economists have seen inflation as the worrying factor. Are you a little relieved to see that there has not been a big jump in inflation for the last month? It's there about the same?
Not going much into the detail which other two panelists have already talked about. What are the risks we are seeing in this inflation print? Clearly, the protein-based inflation is still high. So if you look at food inflation as from cereal side as deflation has increased, but if we see the egg, we see your oil and fats, whether you see the pulses, the inflation is rising. On top of it, superimpose the July more than 4% price hike of the milk products by the Amul, followed by, at least in the north, the Mother Dairy and other regions there. There is, this inflation is going to increase. The vegetable pulses has become more a stronger inflation. When you look at oil and fats, it's last 5-6 months that it is in excess of 20%. And the health inflation, which is more structural now, because last 3 months we have seen it's more than 7%, and post-COVID the health inflation is becoming stronger and stronger. So these things are likely to keep inflation high. Overall, entire year we 5.5% or thereabouts, maybe even take a couple of basis points. Monsoon is a risk. High commodity prices are a risk. And there are supply bottlenecks, which are because how can one explain the rising core inflation at a time when the demand is weak? So unless those bottlenecks are taken care of, inflation will remain high. On IIP, it is still rather than going 130% positive growth to 30% positive growth. We look more at where we are compared to Feb 20, just a month before the lockdown started. And if you look at that, barring electricity, whether we look at mining, whether we look at manufacturing, we are still lower than the February 20 number. So that number will always remain volatile. Unfortunately, this gives us only the corporate manufacturing numbers. We don't have anything what is happening to unorganized sector, unregistered sector, which is likely to have a bigger impact.
All right, let's talk a bit about the IIP numbers that have come in at 29.3%. Of course, the low base effect is there. But we are definitely seeing some impact of the second wave. Aditi, what is your take overall? Do you think that it's safe to now say that at least economically, the second wave impact was less than what was expected?
So on the IIP side, I'll also have one more data point in terms of comparison because the YOY numbers are so meaningless as Dr. Pant just pointed out. If we compare the IIP index levels in May 2021 with May 2019, which is the pre-COVID level, all of them are actually lower. Whether we look at the headline IIP, we look at the three sectors, or we look at all of the use-based categories. So that's telling us that obviously the demand and supply both have taken a hit during the second surge of COVID-19 with the widening state-level restrictions. And that is something that we need to watch for in terms of a recovery which is incomplete right now.
How do you look at the IIP numbers, Anubhuti? Is there a concern over here in certain sectors, considering that the second wave in terms of restrictions did see a lot of sectors feeling the pinch, but not as bad as the first wave?
The second wave has obviously been less adverse for overall economic activity. Whether you talk about IIP or you talk about high frequency indicators like electricity consumption or rail freight, car sales, etc. It's a pretty well established trend in India as well as across the world that as economies adapt living with the COVID infection, the impact on economic activity has been less across the world. So it's once again evident even in the IIP number. Unlike last year, where we really saw in the months of April and May economic activity coming to a standstill, this time a lot of activities were allowed to continue, at least on so the supply side issues were not as bad as it was last year, and therefore we saw IIP staying at much better levels and other production indicators at a much better level. The key part is how much demand can come back, because if production or IIP numbers have to be, have to recover all the way back to pre-pandemic level, revival in demand on a sustained basis is necessary, and probably that is one area where we all need to be extremely cautious rather than just reading the headline IIP number either for April or for May.
Let me get a take from Dr. Pant as well as far as growth is concerned, manufacturing is concerned. Are we seeing that turning point of manufacturing taking place over the last few months, or is this mostly about base effect in your view?
Look, IIP number will be volatile. When there was normalcy in the economy, even then we had seen the numbers had been very volatile. That volatility is likely to continue. Saying that because look, last year was totally complete lockdown. So yes, if one looks at from the complete lockdown point of view to where we had reached in the month of May, and if you look at applying the same yardstick, we had in April we were 94% of February 20 pre-COVID, and in the month of May we are 87%. So yes, it has disappointed, and more disappointment has come from the manufacturing side. It is over the years. If you look at the past few years when the IIP growth has been pretty low or the manufacturing growth has been low, it is the electricity sector who is providing us support, and in fact that is the sector which is showing more than the pre-COVID level production from December of last year. Now, can we just bank on one particular component of from the IIP? The answer is no, because if we are looking at entire economy, the demand is muted, and with muted demand, we can't have a buoyant or booming manufacturing sector, because it may remain there for a month or two. After that, you will have more of inventories piling up and the production suffering. And in fact, if in the month of April and May, because of partial lockdown or regional lockdown or statewide lockdowns, the manufacturing activities were continuing, but if they were the sales were not there, because it's only in most of the April and May, it was only the essentials which were being sold. So my worry is maybe in months to come we may see a weaker IIP print than what we have seen in the month of May 2021.
I'd like to take that question to Anubhuti. How do you think the response will be? Clearly the focus continues to be on growth. Do you think there's any scope of a rate change with inflation like this? And is inflation expected to hold steady in your view?
Not really. If we look at the average, I think from RBI's or MPC's perspective, what matters is the average inflation, both in the current quarter, as well as what the average inflation would be from 12 months perspective, rather than 1 or 2 months of CPI print of above 6%. If we look at the first quarter of FY22, the average CPI print is at 5.6%. Okay, so not really high. In fact, we were forecasting 5.8%, so it gives us some buffer to absorb any price shocks over next 9 months. From the RBI's and MPC's perspective, it's pretty clear from the recent comments which we got from one of the MPC members, the non-RBI MPC members, and even RBI governor's comment last week, that they are likely to read the spike in inflation above 6% more as a factor of supply-side disruption rather than demand-led inflation increase. They'll also read it as transitory, which effectively means that as far as the August policy meeting is concerned, they are likely to stay focused on growth, even though discussion on inflation might increase during the policy statement as well as when the minutes are released. In our view, headline inflation is likely to average at 5.4% in FY22, and that effectively allows RBI/MPC to remain supportive of growth. And we expect that policy normalization will be very staggered, possibly starting in the December quarter with a reduction in overall liquidity stock, followed by restoring of the pre-pandemic LAF corridor back to 25 basis points in April policy meeting. Repo rate hike in our view is still almost more than a year away. So probably we'll see a 50 basis points of hike in August and October of 2022. Even then, rates in our view will remain lower than the pre-pandemic level. So yes, as long as the CPI print of above 6% is temporary, which in our view is temporary, we think we have seen the peak on CPI. RBI is likely to stay growth focused and will start normalizing once they get more confidence on vaccination coverage and sustainability of growth recovery.
Dr. Pant, your comments on how you think the Reserve Bank of India will respond?
It is unlikely that RBI is going to do anything at least in this calendar year. Even if inflation remains somewhere around in the neighborhood of 6.2 or 6.3 or 6.4%, or so to say, even if remains in excess of 6. As of now, in order to give some fillip to the growth, it will continue to remain in the accommodative stance. However, at a time when there is mainly a demand issue, and demand issue originating from the slower growth of income, people losing jobs, employment related issue, it is unlikely that ultra-low interest rate will have a significant impact on the demand. So from that point of view, it will remain on hold, more likely in calendar year 2021. And even after that, because the first policy will be before the budget, and just before, around budget time. So how the borrowing program government is thinking about, based on that decision may take. Had it been a normal year or the normal circumstances, RBI may have moved away from the ultra-loose monetary policy or from the accommodative stance to a neutral kind of stance. But looking at the situation which has prevailed last fiscal year, FY21, and this year, it is more likely to have maintained the current policy stance, at least for calendar year 21.
All right, let me circle back to the question on inflation. How do you think the MPC is going to respond to this? There was a sense at the last, RBI meet that the RBI is not going to sacrifice growth even if inflation is now lurking its head. Aditi, do you think that stance will continue at the next MPC meet?
So, in terms of what we've seen in the last 2 months, certainly the number has remained above the 6% upper threshold of the MPC. And that is something that we think will inject a tone of uneasiness as far as the next policy review is concerned. However, we do think that the numbers have peaked out and we are going to get lower numbers going forward. Our average inflation expectation for FY22 is now somewhere in the range of 5.5 to 5.7%. So it is a little bit on the higher side. And that is something that is going to put a floor as far as any expectations are concerned. Going ahead, I do think that today's number has at least put aside concerns about a premature lift-off as far as policy normalization is concerned. And after seeing today's number, I do think that max, we could expect that the stance would get changed from accommodative to neutral in the December policy. No earlier than that. But really, we don't expect too much of rate normalization to happen, too much of a movement toward rate normalization to happen in Q3 now. So we're back to our earlier expectation of the baseline expectation being that we will move towards a neutral stance and some increase in rates in Q4.
All right. Thank you so much to all of you for joining in on your comments on the IIP and CPI numbers that we saw today. The big question mark, though, remains to be the pace of vaccination that we're seeing. At 30 to 40 lakhs a day, we're steady, but not high enough, not nearly high enough to be at least 50 to 60 lakh people a day that we need to see to really make a difference. So we'll have to wait and see if that actually happens.